I'm sure you've heard lots of people talk about how you should be building a balanced portfolio with the exposure to stocks and bonds. But have you ever thought about how you might want to use structured products as part of an overall portfolio outlook?
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This past week, we talked about using structured products and specifically things that can offer some protection in terms of a downside and different ways of getting exposure to capital markets. And it's the sort of thing that a lot of people never really think about. The thing that you need to understand about structured products is that they've been around for maybe 15 or 20 years now. So they've become relatively mainstream for certain segments of the industry, even though many people who take a more traditional approach have either never heard of them or give them short shrift and don't give them a lot of consideration. And I think that's a mistake. Obviously, you need to build a portfolio that's suitable to your risk return appetite, to your profile, your disposition, your cash flow, your time horizon. All of those things remain key to portfolio construction and wealth management and making better wealth decisions. What people oftentimes don't really think about is their risk tolerance as well as their risk capacity, and they're different things. Tolerance is a psychological thing. How can you deal with sleeping at night if your portfolio is down? Whereas capacity is something different, which is to say, even if you can sleep well, if you need the money and it's down, if you're a retiree, for instance, you might not be able to have the capacity to withstand a major drawdown. Structured products, including notes that can be used to offer downside protection and oftentimes give you inverse participation, which is to say notes that go down when the market goes up and up when the market goes down, can be great diversifiers for people who are trying to manage risk in general. Now, the thing that you need to know is if these notes are doing poorly, that might very well be because they're a small sleeve of your portfolio, 10, 15, 20%, and the other 80 or 90% is doing very well. And that's an important part of diversification. If everything in your portfolio is going up or down at the same time, you're probably not doing it right. You have to find different things that zig when other things zag, things that are not always moving at the same time. That's called having a weak or negative correlation. That's important in turn because of what is known as loss aversion. So it has been shown very clearly by Nobel Prize winning research that people feel the pain of a loss twice as acutely as the joy of a gain. If you can therefore find a way to mitigate that pain of that loss, that will probably go a long way in getting you to take your long-term view, to stay the course, to maintain both your risk tolerance and your risk capacity for the longer-term perspective. So here's an example. Let's say you have a 15% exposure to inverse notes that are inverse on the S&P 500. These are things that will go down when the S&P goes up and up when the S&P goes down. They oftentimes will have a barrier, which is to say if the market goes way, way up, you're only going to go down 5 or 10%. So the loss is largely an opportunity cost in terms of the money that you could have made had you had that additional 15% of your portfolio going up. But think of it from the other perspective. What if the S&P 500 goes down? Now, if you're down, let's say the S&P is down 25%, the other 80, 70, 60, whatever percent of your portfolio is going down, but you've got 15% of your portfolio that is actually going up, so that the total portfolio in aggregate is not going down very much at all, because even though the other 60% is going down, this 15% is actually going up to offset that, so that the total performance might be a drop of, say, 10 or 12% instead of 20 or 25. That will go a long way to getting most people to take a longer term view, to maintain the focus and discipline that they require to make sure that they can reach their longer term goals. I'm not saying that structured products are for everyone. I'm not saying they're going to be ideal, but they can be very useful for people in modifying their behavior so they can stick to their plan and make better wealth decisions.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.